Hello and welcome to the Business Standard Banking Show. PNB Housing Finance, the fourth largest housing finance company in India, reported 46% year-on-year growth in its net profit to rupees 383 crore for the second quarter. There was a marked improvement in asset quality and sharp decline in credit costs, though margins fell on a year-on-year basis. Girish Kousgi, the MD and CEO of PNB Housing, is with us today to talk about the Q2 numbers and the strategies going ahead. Mr. Kousgi, welcome to the show.
Thank you.
Let me start with the asset quality. Gross NPA declined sharply by 197 bips to 1.78% as on September end, mainly due to resolution of a large corporate loan. Retail NPAs also declined. Where do you see the gross and net NPA numbers by the end of the current financial year? I am trying to understand whether you think there is much more scope to lower the numbers.
Good morning. Thank you once again for getting me on the show. So actually, every quarter our GNPA will keep coming down. Now, corporate is now more or less done. We just have one account and the GNPA is less than 3%. On retail, it is 1.74%. So every quarter we will see GNPA even for retail coming down.
Okay, you see improvement from on asset quality front going ahead.
Yeah,
Okay.
that's right.
The second aspect was the corporate loans. PNB Housing has reduced its corporate loan book very sharply, which was perhaps a conscious strategy. But do you think the reduction part is now over and going ahead, the bank will start growing the corporate loan book again?
So it was a conscious call to degrow corporate book because we saw stress. We had NPA close to about 35%. And at one point in time, the book was about 18,000 crores. So we thought we should first work on resolving NPA accounts, bring down the NPA to a comfortable level, degrow the book, and then look at restart. Now, I think both of those are done. So now book is down from almost 18,000 crores to 2,400 crores. And GNPA, which was about 35% on corporate, today it is less than 3%. So it is only, I think, few quarters away from restart. Maybe 2-3 quarters from now, we'll be starting, business, corporate business, and it will be a very, very, thought through strategy on corporate. We would focus only on construction finance, select business, in terms of enabling retail business. So we'll do corporate business only to help us grow on the retail front, and therefore we will do only construction finance. We'll be focusing on select builders, select projects, select locations. So I think that's our strategy. And in terms of the overall portfolio, corporate would not be significant. I think it will be less than 10% at its peak.
Now, coming to the retail loans also, PNB Housing has plans to change the retail loan mix. Wanted to focus more on the salaried class. I would like to know what was the reason for this strategy.
So I think we had taken a call that when we stopped corporate, we thought that we should grow our retail aggressively. And within the retail pool, obviously, we also had higher GNP on the retail front. And therefore, we thought we need to do small tweak with respect to product and profile. So when we talk about profile, we were slightly skewed towards self-employed. So we thought we need to bring that down to a certain level. And that's the reason why we thought we should change this, because it is known that self-employed would come in at a higher risk and therefore higher delinquency vis-a-vis compared to salaried. And we thought salaried in our book was quite low compared to the industry level. And therefore we thought we need to get that right. And that is where the small shift in terms of increasing salaried and reducing SCMP. I think now it is more or less done on an incremental basis. It will catch up with the book going forward. I think that's the reason why we had to do this.
What is the ideal mix you are looking at from salaried and self-employed?
I think anywhere between 65 to 70 should be salaried and the balance should be self-employed.
What is the overall loan growth target for the current financial year?
For the year, we had guided 17% growth on book, and we will get there by March. And on disbursement, the growth, we had estimated about 20 to 23%, and that is as per the plan.
So as of now, you are not seeing any impact of higher interest rates on home loans. Home loan demand continued to be strong despite higher interest. Is it?
I would say that demand is very good, quite robust across geography. There is also competition, not that there is no competition, which is why we had a strategy of moving away from super prime, because super prime is really crowded, because all the banks, both private and PSU, and some of the large NBFCs and HFCs, they are focused on super prime, and therefore we have to move completely out of super prime. This is our strategy. So now we are trying to identify certain segments within prime where we can try to build book at a higher yield. So there is huge demand for home loans across all segments, whether it is super prime, prime, affordable. I think there is demand, and therefore our growth guidance is in line, and we'll be able to achieve that.
For our viewers, super prime would mean the very high value home loans, more than a crore. Is it right?
Super prime is basically where lot of private banks and PSU banks would focus, because these are high ticket
High ticket,
and
yes.
very good profile. The pricing would be very, very competitive. Considering our cost of funds, we thought we should not be in that segment because it doesn't support us on the profitability. And also, we had started affordable business called Roshni. We started that business about 8 months back. Uh, Very happy to share that it is on track and there is very good traction. We have reached a book of 750 crores as of last quarter end, that is quarter two, and very soon we'll be hitting 1,000 crores, and probably will be the fastest to build a book of 1,000 crores in affordable.
Now, coming to the NII growth, NII growth was only 2% on a year-on-year basis. What could be the reason for such muted growth?
Actually, last year quarter two we had a one-off. So if we see the growth without one-off, revenue has grown by 17%, NII has grown by 35%. So actually it is 35% growth on NII. Only because there was a one-off last year quarter two, it looks 2%. Actually, it's 35%.
So those Q3 and Q4 NII will back to its normal growth
So
trajectory.
I think on the core business, NII will definitely, there'll be a very good growth, and no, only because of one-offs, it could be slightly, it might look muted.
No, I'm asking this because a lot of people are saying the cost of funds, the cost of funds are still rising, and yield of advances may have peaked. So in that context, your margin, the spreads on loans was 2.59% in Q4 in Q2, as compared to 3.38% in Q2 of last year, and 2.62% in Q1 of Q4. So from a spread point of view, do you think spreads could improve going ahead, or do you think there could be a pressure?
See, also, we should keep one more thing in mind. See, we are degrowing corporate book. So that also would have some impact on the net interest income, on the revenue as well as net interest income. So it's a conscious call. Anyway, now the book is hardly anything out of total portfolio. We had guided spread of 2.5%, give or take plus or minus 5 bits, and NIM of 3.5. Today, our spread is 2.59 and NIM is 3.95. So I think margins will be able to maintain. There is absolutely no challenge on margin.
Now, on the borrowing part, the PNB Housing's bank borrowing is 40% of the total funding. It has slightly came down from the previous quarter, I think. Is there a plan to further lower it at a time when the Reserve Bank is saying that NBFC should lower the dependence on bank borrowing?
Yeah, absolutely. We are trying to bring down the bank borrowings because of two reasons. Of course, one, we thought, obviously bank exposure was slightly high within the liability mix. That is one. And number two, we also have various avenues, for a lower cost. For example, now we have access to NHB funds, which will come at a lower cost. So I think next 2-3 quarters time, we will see, the bank, which is 40% now, can come down to about 36.5 to 37%, and NHP would go up, and CP, NCD also would marginally increase. So there'll be slight change in the liability, but not too much of a change. There'll be a slight change, but not too much, because I think beyond the point we are agnostic in terms of source. whatever fits into a cost structure, we would look at that avenue for fundraise and keeping our cost low.
On that note, thank you, sir, for speaking to Business Standard. It was a pleasure talking to you.
Thank you so much.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.